Hey, welcome to the podcast, everybody. Thanks for joining me. Appreciate it. Well, you can see from the looks of the screen here that something big happened today, and helicopter bin delivered. The Fed entered into QE3 officially. They agreed to buy $40 billion a month in mortgage bonds. They basically did a couple of things, and they extend out zero interest rates to 2015. So we'll get into that in just a minute. Let's run through the numbers real quickly here. You can see interest rates came down. They were all over the place most of the day. Obviously, volatility came way down on the VIX. Oil stocks, material stocks, NASDAQ, semiconductors, Russell 2000, the financials, you name it, it was up today. What was down was the dollar. So we start out, the Fed has obviously announced QE3, and I'll be like a two-handed economist. On one hand, I was correct because I'd been talking about QE3 coming for some time. On the other hand, I was wrong because I didn't think they would do it at this particular meeting. And the reason why was, if you look back at history, in fact, we wrote a blog article on karleggers.com, I guess just a week ago or so, about the fact that typically QE3, or not even just QE3, but QE1 or 2 or Operation Twist, all these things came generally after the market had fallen, and it was almost like a backstop. But with the markets at highs, economic data that wasn't great and maybe deteriorating, but wasn't necessarily awful, I think that it was going to be something new for them to do this at these high levels. And they came in and did it anyways and gave the markets exactly what they were looking for. So those that were betting on stocks the last couple of days coming into this, and you saw steel stocks and things like that rally, material stocks in the last couple of days making a bet they would do it, they got what they wanted because the Fed did come in and do this, and it was basically a bazooka, so to speak. And so now you got the ECB doing this, you got the Fed doing it. Again, a risk if you're somebody that's short is that China comes in and says, hey, we're going to jump on this and do the same thing or something similar, and some other type of plan they could do. But in general, the thing is, when you look at the stock market, and you can see here it's firmly has broken out above that 1420, 1425 level on the S&P. But here's the thing. If you look at this and say, well, if things are so bad and they're having to do this, why on earth are stocks celebrating as if things are just fantastic? The reason why is this picture. This is the dollar. The U.S. dollar is getting torn apart right now. The reason why is because obviously the Fed is printing more of something that is becoming worth less. So what investors are doing is not so much that stock investors are saying, hey, we think stock market's the greatest place ever. They're trying to avoid other areas. So they were avoiding the dollar. So you're getting penalized to be in dollars, and you're saying, well, I need to jump in something else then. So where does it go? Oil, material stocks. So who really got helped today? Who really got hurt? The people that got helped are those people that are in stocks, certain types of bonds, REITs, basically anything that's not the dollar. Who is getting hurt? Mostly it's the U.S. consumer because their gasoline prices are going up and going to continue to go up. Food prices are going to continue to go up because of this. And their savings accounts are going to continue to pay nothing at least through 2015. And when they take that measly 0.5% out to go buy something, it's going to cost more in the future. So what happened was, for people who are asset allocators, they have to shift out of those types of vehicles and into the vehicles that are going up, which are stocks and bonds and everything else. So really who got hurt today are the same people who have been hurt the last few years. Those that are on a fixed income and have to do things like, oh, I don't know, eat and clothe themselves. Those are the people really getting hurt. But the Fed is hell-bent on keeping interest rates low and trying to, in this case, go in and buy mortgage bonds, which was something we had heard that they would possibly do, and keep and push interest rates even further down. And as you look at this, though, to me, that's not going to get the unemployment rate down, but it will potentially help equity prices go higher. So now what we have to do is say, okay, well, we know fundamentally things may be getting worse or bad, otherwise they wouldn't be doing this. What do we do about the stock market? The stock market is moving on its own accord because this is the proverbial don't fight the Fed, and this is don't fight the Fed exponentially, right? This is when we used to talk about don't fight the Fed in the 80s and 90s, we never would have dreamed of a scenario like this where you really don't want to step in front of the Fed because they are really got their foot on the accelerator. And so money has to find a place somewhere, and it's finding its place in the markets. Now, one thing that we want to do, though, is we want to say, okay, if we're going to be invested, A, we have to have an exit strategy, and B, how do we get from A to B? If you're somebody that has too much cash, and I've got more cash right now than I would like, based on the fact of the fact that we were at this triple top, we have still had some deterioration in the markets, and as we know, the economy is not producing enough jobs, fiscal cliff, all those negative things are still there. How do we participate and still have an exit strategy? And I think one thing that we have to do is look at when the markets get overbought and oversold and pick our points. Right now, the market is extremely overbought when you look at all types of things. Like sometimes what you like to do is look at some of these things like a pendulum. How much money is going into stocks? How much money is going into bonds? Right now, we're kind of pinned where stocks are really expensive, and they should be coming down. When you look at things like the high-low ratios, they're up at levels where we've seen corrections in the past. So don't be surprised to see this thing reverse, even if it's not a big reversal, just a reversal that might give you a better entry point. With that said, big caveat, if you're somebody that said, hey, I'm not going to invest anything until I see how the elections go and what's going to happen with the fiscal cliff, you're sitting on the sidelines and the market keeps going on without you. So you have to participate, but just have to do it in a more methodical manner. And that's difficult to do because this market is not giving you many entry points. So the other way to do it is obviously to look at individual securities and pick your spots at that point as well. So looking across the spectrum, you have a lot of stuff that is overbought. So I think you have to either use time stops to get in, which is another word for saying averaging in, but you can't afford to be doing nothing because the market, the price trumps all, and right now the stock market is going higher, whether it should be or not, and that's a big thing. I talked to a lot of you who don't think it should be going up, and it may not. It may not should be going up. It may not should be going up. It shouldn't necessarily be going up, but it is. And again, the stock market is a different vehicle than the economy. And while the economy, in fact, we saw today, and I put it out on Twitter, the ECRI, which has been very accurate in the recession calls, they are still holding to that recession call, saying we're in a recession right now. And a lot of people are saying, you're crazy. What are you looking at? One thing that they're pointing to is that recessions aren't felt, or you know, it's always one of these things where you look back in the rearview mirror to understand that you were in a recession. And so they believe we're in a recession now, and perhaps we won't even recognize it until December or maybe even January. On top of that, they point to the fact that there's a lot of revisions downward back in the 07, 08 time frame during the Lehman financial collapse and so forth and the financial crisis that we went through. There's a lot of times, I think GDP was revised down a whole 2 percentage points at one point. It went from like 4% was the original number, everything was great, to 2%, uh-oh, something's wrong. There was a big revision down. So that's something that they feel is going to come in the next few months, big revisions down. And perhaps the Fed sees that, and again, their answer is to keep interest rates low, which isn't the answer. I think this is more a fiscal issue, not a monetary issue. That's a whole other story. What we're trying to do here is make money. Where we're seeing the money being made the fastest right now is in areas like small caps and materials. You know, you look at something like DBC, which is a power shares commodity index tracking ETF, and it's had a big run since June and July. And again, I was actually thinking the market may sell off even if QE3 was announced because it was already priced in. However, it was kind of this bazooka. It was a multi-pronged effect that he was giving the market. I'm going to do this, this, and this. And so you're seeing commodities run up and small caps are run up. And those are risk-on type investments, which is good that those would be going up. Again, going back, though, to what I originally said, the fact that they are going up means that commodity prices are rising. And that means more and more people are getting hurt who are unemployed. And we know adding 64,000 jobs is not going to get this economy back on track. So, again, though, if you're somebody that believes we are in a recession or the economy is horrible and you're seeing this disconnect between the stock market, you have to separate that. What you think should be happening, and I'm going to agree with you maybe, that things shouldn't be going the way they are, the stock market is telling you something different. And so what we have to do is adapt to that and say, okay, maybe we underestimated it. Where should we be now? That doesn't mean go all in at all, especially after a 210-point day. But it does mean that each time we've had these episodes in the past, the market has continued higher. We'll see if this one's any different from the past, because we've talked about the fact that each time they've done this, there's been diminishing returns in its effectiveness and on the stock market performance. But regardless, the Fed is going all in here, and we have to recognize that and think that stocks could go much higher, not necessarily because that's where people want to be. It's because that's where they have to be, because that's one of the things that's making money, and it's one of the places, it's a place to be to avoid other areas like the dollar. One of the main beneficiaries, obviously, of what the Fed has done has been gold. We'll switch to that here. Gold, this is the GLD, obviously. Gold has been actually doing very well in advance of this, and it was more, kind of a technical move, and we'd written some articles about gold and the fact that every time it had kind of been this sideways for this long, and remember, it's been sideways for about a year now. If we go from this August all the way back, you can see gold hasn't been, around the 1550 range for a year now. Yeah, much higher up here, obviously, and lower down here, but essentially it had been moving sideways, and when it had done that in the past, starting in 2001, it was ripe for a rally. So I owned gold, have owned gold for a while, GLD. In addition, some of my more aggressive accounts owned the miners, and you can see they had really, right when they started to kind of make this double bottom, we took a position in them, and they have gone vertical as of today, up 5% today, so a big, strong day. I don't see why that anything would change with gold. I think gold by itself could easily get to 2,000 an ounce, and again, I'm not one to start running out storing gold inside my bunker, but I do think we have a way to trade this stuff, and gold is going to be a beneficiary of what's going on, because more money printing is coming, and bond buying, and just more of the same, really, but in larger fashion. So that's what we're getting right now, and gold's been a big beneficiary of that. All right, switch off of QEing the Fed right now, and we'll switch to Apple, because Apple was kind of the big deal yesterday. I am long Apple. This is a disclosure. I have been for a while. Apple is, they came out with the iPhone 5, and personally, as somebody who owns, several Apple products, I wasn't really wowed by the new iPhone. Perhaps I saw some of the leaks and things that I thought might be there, which is it's a longer, a thinner phone. Obviously, it's going to run on a faster network, the LTE network. It has more icons, battery life's better, a better camera. There's a lot of improvements. It's not necessarily it's not a better phone. It's a much better phone. It's just that I thought it was missing the wow factor to really get people that, if you're somebody that has an iPhone 4, are you going to go out and upgrade to the 5? I think if you had the 3, there was a good reason to go upgrade to the 4. It was a much different looking phone. I don't think it's going to be the case this time. So, I still own Apple. I think it's a great stock. I was just a little disappointed in the overall the overall phone. And also, we do have things to look forward to, though. And they may be pacing this out. They introduced the new iPhone, obviously the new iPod and Shuffle, but the iPad Mini is still yet to be seen, and it's coming out. It's going to be a smaller iPad that's going to compete with Apple, not compete with Apple. It's going to compete with Amazon's Kindle Fire. In addition to that, and that's at a different price point, obviously, maybe in the $200 range. In addition to that, Apple TV is something that we might see down the road. So there's still plenty of good things going on at Apple, but it certainly, to me, didn't feel the same as when Steve Jobs comes out and explains, these new products. It didn't have the same wow factor. But regardless, you saw a lot of upgrades today, and I think the stock is, on its way to $700, and you'll probably see the stores very crowded in there, and I remain along the stock. Before I forget, let me circle back around real quick. If you're somebody that has too much cash, you're looking to get invested, how do you do it? Are you wanting to go to an area like materials or small caps, but you're kind of concerned, how do I do that? I think the first step is to get into places like utilities. Telecom has run up, but look at something like utilities here on the screen. And I mentioned this, I think I mentioned it either on Twitter or on a podcast earlier in the week, that Utilities had a pretty decent correction here. You know, XLU was down from 38.45 down to 36.20. You know, about a 5% correction. And in this environment where we're still worried about the economy, and yet we want to be invested, how do we participate? And I think the first step on the risk scale is to get that cash invested in places like utilities. Now, there may be another step to say, well, I'm going to go out on the risk scale more. But I'm just saying, if you're somebody that has a lot of cash and you're saying, how do I get in this market? Because as soon as I get in, that's going to be the day it starts to go down. Utilities is a great place to start. You can see here I've shown the old breakout, and now it's come right back to it. And this is a time where you don't want to necessarily look at moving averages, because if you notice, it went up and down over the 50-day moving average several times. It bounced off the 200 a couple of times, but it never quite got down there. This time, actually, this line was more important, which I drew because that was the old breakout, and now it's coming back to it. So you're still getting a 3.7% yield, and very liquid, obviously, and something that's not reliant necessarily on the economy being strong. So I think it's something that fits in a portfolio before you go out to that next step on the risk scale. All right, guys, I appreciate the time. Keep checking out KarlEggers.com, Twitter, Google+, EggersCapital.com as well. And we will talk to you soon. Have a great day.